Are you struggling to keep up with your mortgage, personal loan, credit card, or car loan repayments? You've probably heard people say, just apply for hardship. But what does that actually mean? How do financial hardship applications work? What do lenders look for? And why do some hardship requests get approved while others get declined? In this video, I'll explain how the hardship process really works and what you really need to know before you apply. But first of all, welcome back to the channel. If you're new here, my name is Nova. I've spent over 15 years in banking as a credit risk professional, and here I break down personal debt and lending through a risk lens. And if that's useful to you, consider subscribing and like each video that makes a difference to you. And everything I share here is purely for general financial education and is not meant for personal financial advice. Financial hardship is one of the most misunderstood parts of lending. Many people think that hardship means their repayments disappear. Others assume they'll automatically be rejected. The reality sits somewhere in the middle, and let's break it down. So, what's financial hardship? Financial hardship occurs when you are temporarily or permanently unable to meet your loan repayments because of a change in circumstances. Some common examples include job loss, reduced working hours, illness or injury, relationship breakdown, increased living expenses, natural disasters, unexpected financial shocks. And hardship isn't about not wanting to pay, it's about experiencing genuine financial difficulty meeting your obligations. The purpose of hardship assistance is to help customers recover and get back on track. So when should you apply? One of the biggest mistakes borrowers make is waiting too long. Many people only contact their lender after they've already missed multiple repayments. The best time to apply is usually as soon as you realize you are likely to have difficulty making future repayments. For example, if you've just lost your job and know your income will be affected next month, that's often the right time to start the conversation. The earlier you engage, the more options may be available. And what happens after you apply? Let's look at what typically happens behind the scenes. The first step is that the lender will receive your hardship request. Secondly, they'll gather information about your circumstances. This may include your income details, employment information, recent pay slips, bank statements, details of your expenses, information about what caused the hardship. And the third step is that the lender will assess whether the hardship is genuine and whether there is a reasonable pathway for you to resume repayments in the future. This is an important point. The assessment is not just about today's situation. It's also about whether the proposed arrangement is likely to work. Lenders generally want to understand what is the customer's recovery plan. And so what support options might be available to customers. And depending on the lender and your circumstances, support options may include reduced repayments, temporary repayment pauses, commonly known as payment deferrals, interest-only arrangements, long-term extensions or loan restructures, among others, like allowing you even time to sell an asset if that's a pathway. The exact solution depends on the type of debt and their financial circumstances. Not every customer receives the same arrangement. The goal is usually to create a realistic pathway forward. And so why do some hardship applications get declined? And this is where many people become frustrated. A hardship application doesn't always guarantee approval. Common reasons a request may be declined include insufficient information provided, lack of supporting documentation, or even the proposed arrangement is not sustainable, or the customer circumstances are unclear, or even that there is no realistic capacity to resume repayments afterwards. And in many cases, the issue isn't that the hardship isn't real, it's that the lender can't determine whether the proposed solution will actually resolve the situation. What do lenders really want to see? If I could summarize it in one sentence, it would be this. Lenders want honesty, they want communication, and a realistic plan. The strongest hardship application usually explains what happened, demonstrate how circumstances changed, include supporting evidence, and show a pathway towards recovery. The more complete and transparent the information, the easier it is for the lender to understand your situation. So now let's look at some of the common myths about hardship. Let's quickly bust a few myths. The first myth is that hardship means I don't have to pay my loan. Not necessarily. Hardship assistance often changes repayment arrangements, but it usually doesn't make the debt disappear. And the second myth is that only people who are unemployed qualify for hardship solutions. Not true. Many hardship applications involve people who are still employed but facing increased expenses or reduced income. And the third myth is that if I'm in hardship, I should avoid my lender. In reality, early communication is often one of the most important factors in finding a workable solution. And as I conclude, I just want to say that financial hardship is designed to assist people experiencing genuine financial difficulty. The process typically involves explaining your circumstances, providing supporting documents or supporting information, undergoing an assessment, working with the lender to identify a suitable solution. And the key takeaway is quite simple. The earlier you seek help, the more options are usually available. If you found this video helpful, please like, subscribe, and share it with someone who may benefit from understanding how financial hardship applications really work. And thanks for watching. I'll see you in the next video.